Mike, let me actually start with the fiscal policy piece of it, which hits a little closer to home.
Sure. So, the narrative of because we have inflation, we're going to have to look more closely at what we're spending on has gone out the window. And that's true both for the United States as well as across the Atlantic in Europe. You're going to see the spigots open when it comes to defense spending and energy security measures. And those two thematics are here for the long term. They're going to outlive this crisis. And unfortunately, we are not going to be able to put things back in the box after this. So on energy security, you're already starting to see news out of Germany from over the weekend that they've already committed to start building new natural gas infrastructure in order to take liquid natural gas in. They're looking at extending the lifeline of nuclear power plants that they were going to decommission. This is a major U-turn. Just a few weeks ago, Germany was leading the fight at the EU to essentially list natural gas as well as other things like nuclear power as not part of the EU's taxonomy in terms of sustainable fuels.
Right.
And in the US, you're seeing the same thing. Joe Manchin came out right after the State of the Union with a new deal after he killed back, Build Back Better, saying, you know what, maybe we can do some tax and spend and some taxes to reduce the deficit and then use that money to invest in climate and energy. So it's true here in the US. So as you mentioned earlier with spending, that's also true on the defense side.
And let's boil this all down. There's some obvious implications here where, you like industrials like Lockheed Martin, obviously. You're also looking at some dividend players and utilities like American Electric Power. Give us some other plays here for the themes that you're laying out.
Yeah, so volatility is here to stay, so you need to position for that. So being nimble is not something investors have been used to. So when it comes to this, active management is going to become more important. Buying the dip is going to have to also be complemented by actually fading risk at appropriate times. And that's why we think dividends within equities are actually an attractive place right now. Real yields are even more negative than they were before. When we look at things like valuation, that's a major concern at markets. Dividend stocks have sat out much of that move up in markets, so are trading at a 25% discount to the S&P 500. And when you look at inflation, typically dividend growth and high dividends tend to do well in inflationary regimes. So things like utilities, industrials, energy, as you mentioned, American Electric Power, you mentioned Lockheed Martin. These are the types of things that are actually going to benefit. They have dividends that are higher than the market. Their valuations are more attractive, and they're going to be beneficiaries of these thematic shifts in the market around energy security and defense spending.